doing on your computer?
I'm just selling a couple things before.
And it's not stocks. I can see he's like selling a piece of furniture.
No, I'm not.
Yeah,
I'm
yeah.
selling I'm selling stock stuff.
It's an
doggy.
armoire.
It's the market could be. I mean, we've had quite a bounce, but I'm like making sure that I have positions that are expiring tomorrow. So I'm like, okay, I want to make sure that I'm ringing the cash register real fast. So excuse me, I'm sorry. Very unprofessional. Sorry.
Or very professional.
Yeah. Ooh, I'm up $1,000 on Tesla calls for next week. I will ring the register there. Thank you so much.
Ben.
Elon Musk. Fuck you, Elon.
Should we talk about him for a second before we have to?
Yeah, I guess. Wait. So the thing with Snapchat, it's not unique to Snapchat. There's this Deutsche Bank, this guy from Deutsche Bank said...
Who you hate.
No, I don't. I have no opinion.
You do.
I hate Deutsche Bank or this guy?
You hate Deutsche Bank.
Sure, certainly.
There's an episode where you fucking are like, Deutsche Bank sucks.
They're also kind of a joke of a bank. Like, they're the
Deutsche
butt.
Bank?
Yes, just a garbage shit bank. He said it, folks.
No, you said it.
Okay. Well, there you have it. I guess I did.
But now you're like, I love their analysts. All I use is Deutsche.
No, but what this guy said is a quote. While the excess valuation premium has largely been wrung out, a.k.a. stocks have dropped, valuations have dropped, it is not yet low, and valuation concerns are now giving way to earnings concerns. Meaning, at the tippy top, it was like, wow, a lot of these rates are going to be rising and interest rates are going to be rising. So a lot of these valuations are a little lofty, right? Well, now that's giving way to earnings concerns. And he goes on to say, forward estimates, a.k.a., when companies are making estimates like Snapchat did about forthcoming quarters, have begun to be downgraded but remain well above prior trend levels, leaving them vulnerable. So, yeah, there's still a lot out there. And, oh, man, do we even fucking get
All of
into
this could be related, to a lot of, people are going outside again.
Yeah.
People are going to be on... I was on fucking every app so much during the whole lockdown.
Yeah.
Now I'm out there touching grass, baby.
And that speaks to this. We'll touch on that in the after hours, just like digital regulation, because I think that's an interesting conversation. So stick around for that. We're going to be talking about that. But there's this guy from Morgan Stanley, Mike Wilson, who thinks that there's further downside ahead. Can you click that? I liked what he said. He said the bottom line, equity clients, meaning, equity clients in this situation means funds and whatnot who are owning stocks, are bearish overall, and they're not that optimistic about a quick rebound. While this is a necessary condition for a sustainable low, we don't think it's a sufficient one. So basically he's saying, hey, everybody's pretty bearish, and usually that is necessary to put in a low when everybody's on one side of the boat, but it's not sufficient this time. Their 12-month target for the S&P 500 is 3,900. They expect an overshoot to the downside this summer that could come sooner rather than later. While sentiment and positioning for active institutional investors is low, asset owners... So they still have a lot of clients who are really heavily exposed to stocks. As they reallocate some of that money toward bonds, a.k.a. away from stocks, and other assets like bonds that are less vulnerable to the slowing growth / recession narrative, he's saying that should weigh on stock prices in the near term. And then he says, we think that 3,400 on the S&P, which is about over 600-point drop from here, is a level that more accurately reflects the earnings risk in front of us, and we expect that level to be achieved by the end of the second quarter earnings season, if not sooner. Vicious bear market rallies will continue to appear until then, and we would use them to lighten up on the areas most vulnerable to the oncoming earnings reset. So in bear markets, you have days like today that just have really sharp, violent bounces. And this Mike Wilson guy is saying that, hey, use those to lighten up on. So if you're someone out there who's got a bunch of stuff that you're down on, maybe according to this guy, you should consider unloading. But here's what I think.
What do you think, pal?
Sorry, I'm talking a lot. I know. I think that people are conflating a normalization of consumption behavior with a recession. Yes. So what does that mean? I think basically, when we had COVID, shit dropped off, and then it fucking rebounded because you had people staying at home, people trading stocks, and you had the stimulus stuff coming in.
Right.
And there was a massive pull forward in consumption behavior, meaning like e-commerce just like swiped up big time. So I think that since we're now leveling off and going back toward normalization, people are conflating that drop from such a uncharacteristically high in consumption behavior with a recession.
Right.
It's just kind of a reversion to the mean. And so this chart about e-commerce sales as a percentage of total retail sales, pretty much look at that shit.
Yeah, and for the audio listener, it shot up like crazy, and then it looks like it takes a pretty sharp dip, but then starts to level off.
Tapers off. This is the chart from Fred, the Federal Reserve.
Did you say Fred? Did
yeah.
you say
well, yeah, it's
Fred.
Fred, Federal Reserve something E something.
Yeah, Fed.
No, Fred. Fred.stlouisfed.org.
Why Fred?
I think it's Federal Reserve E something. I don't know what it stands for. Federal Reserve. What the fuck?
Economic data.
Oops. Yeah,
Fred.
I knew what it was. I just wanted to see if you knew.
No, you didn't know.
I
knew the E stood for economic.
So, what is interesting though is only. So this is e-commerce retail sales as a percent of total sales. Look how e-commerce, you would think that it would be, the penetration would be so much deeper.
The what?
Penetration.
Would be what?
Deeper.
Oh.
Yeah. But it's not. It's just the tip, so to speak.
Right.
Yeah.
And we're all saying penetrate a little deeper.
Yeah. But it was on such a steady uptrend and then just really went parabolic there.
And then you could say it pulled out a little bit.
Yeah, you could. You could say that e-commerce sales got their nut and they're pulled out a little bit. So and then I was seeing other finance people wigging out because like Amazon, for example, there was a headline that they're getting rid of 10 million square feet of warehouse space, and they're like, oh, Amazon's pulling back, and it's like, yeah, because they overbuilt in anticipation of this trend continuing, but now that it's kind of tapered off, they're pulling back a little bit. That doesn't mean that a recession is necessary or is necessarily going to happen. It's just like, hey, come on, guys, let's use our.
We're experiencing a weird correction.
Yeah, let's use our noggins a little bit here.
Businesses love to, when things are good, they love to convince themselves that they'll always be this good forever.
Mm-hmm.
And then they go, oh, what the fuck?
Yeah.
It's not as good anymore.
Yeah.
And everyone freaks out.
Carvana is an interesting one.
Yeah.
Like that, where it's like, oh, looks like the business model of just buying cars sight unseen and then flipping them in these giant vending machines is perfectly sustainable.
All of these fucking companies disrupting, it's fine. You know, some of you guys have good ideas, but I can't stand. For example, I was in the grocery store and I saw.
Which one? Trader Joe's?
No, it was
some natural Erewhon.
I was up north, so it was a Safeway. And I saw a Dollar Shave Club stuff in the toiletries aisle. And I just hate when it comes full. They're like, we have changed the whole game. You don't buy razors from the store anymore. You fucking join our club and we send it to you and it's the new way to do it. And then just 5 years later, they're like, actually, you can get them in stores because that worked pretty well for everybody.
Yeah.
And that's how we're doing it now.